All right. So it is IFRS 2 we are looking at. For those of you who have never seen this face before, yeah, my name is Dr. Aura. I teach most of the papers at RCM College, and today I'm the one who is taking you through these basics of IFRS 2. So that is it. So we continue now here. Now, my very good students, when we talk of IFRS 2, what do we mean with this topic? Remember, this is a topic that we call share-based payments. Share-based payments, which reminds me sometimes back here when we were starting these colleges when they were very small colleges, if I can remember very well. They were really small. What used to happen, because now we could not afford to pay lecturers, all right? So then we could tell them that you guys, let's just build up your claims. They were claiming. We build up your claims, they reach this level, and then we give you this number of shares in the company. Those lecturers who went for that model today, they are shareholders. They are shareholders. So see, instead of just giving them money, we're giving them what here? We're giving them shares. We're giving them shares. All right? We're giving them shares. All right, just a minute. I just need to come here and open this in a different machine. So I can track your questions and I can get to see, yeah, how the screen looks like. All right. Yeah, so instead of us paying these teachers their salaries and wages, we ended up giving them shares. So that becomes a share-based or equity-settled share-based payment, equity-settled. And then we have also another share-based payment, what we call cash-settled. So how does this cash-settled payment work? How it works, ladies and gentlemen, you are a CEO. So we are telling you that if our share prices, which are today going for 40 bob, if you'll be able to work hard and they start selling at say 60 bob, we are going to give you a bonus of say $1 million Kenya shillings. So you see, we shall be giving you cash, but that cash is pegged on performance of our shares. All right. So I want us to be very clear that in terms of share-based payments, ladies and gentlemen, there are two key models here. The first model is where we are going to give you our equities of the company. The second option is where we shall be giving you cash, but now this cash we are giving you is linked to the performance of our shares. All right. Now, it also happens to suppliers. Suppliers will come and deliver goods. Like right now, we have so much in terms of what we call pending bills. So suppliers, they come and deliver, you're not able to pay them. So instead of really them writing off that debt unjustifiably, you would rather cede some shares for them, give them equity. So definition, if you are able to follow, ladies and gentlemen, here, this note shall be sharing later. So definition, what are we looking at here? And remember, these sessions during the day, they'll only be for 20 minutes, 20 to 30 minutes. So please, you have to be very keen. So definition, IFRS 2, payment for goods or employee services using shares, share options that they can convert later. You know, these are convertible. They're convertible to shares or even money. And then we have cash-based on share price. There are two types generally. Of course, we have a hybrid, but the ones which are known, there are two types: equity settled. Employee receives shares or options. At the end of the day, they don't get any cash. They receive shares or options. What is key here, if it is equity settled, we shall always use grant date fair value. The date we grant the shares to you. the price applicable on that day is what we shall be able to apply for the entire period. So we will not be doing any remeasurement. So no remeasurement. And because we are giving you our equity, we shall credit equity. So basically here, because it's an expense you have offered your service to the school, we shall debit your staff expense. We credit equity. Yeah. So the other components of equity or equity reserves. And then now we have cash settled. So you see under cash settled, what will be happening, my friends? Under cash settled, will give you like a contract. We'll tell you, Mr. So-and-so, you are so talented. You are our CEO. Our share price today is going for 40. All right. Should it hit 80 in 3 years' time, then we shall be able to give you, say, 3 million Kenya shillings. So like the question that came last semester, yeah, they are called share appreciation rights. What basically we abbreviate as SAR like that. So you see, over these 3 years now, great things are going to happen. We cannot, ladies and gentlemen, just leave this guy to go for 3 great years without us tracking his performance. When there are share appreciations, we shall be tracking his performance on a yearly basis. And that is why when it is cash-based, we shall be doing remeasurements every single year. Because if it is share appreciation, we would want to follow and track through your performance. Are our shares, because of the effort you're putting in place, are our shares growing every year? So under cash settled, the employee receives cash. We shall remeasure at each reporting date. And because we're going to give you shares, then we shall credit liability. All right. So basically, we shall debit an expense because you have offered service to us. It's an expense for the company, but now we credit our liability. Yeah. So the vesting period, the expense is recognized over the period. Employees must wear the vest. Employees must serve. A formula very, very important for you to understand this. If it is equity settled, ladies and gentlemen, if it is equity settled, our formula is very, very easy. You take the expected awards, how many shares are given to these directors, times grant date fair value. Grant date fair value is what will apply throughout. If they're going to give you shares, the date we made that promise, the fair value, the market value that was applicable by then is what we shall use throughout. So the expense for the period will be expected awards times grant date fair value times time proportion. So for example, if it is year 1 and the vesting period was 3 years, it will be first year 1/3, second year 2/3, third year 3/3. How about if it is cash settled? How do we calculate this expenditure? Take the expected awards in Kenya shillings, and because it is cash settled, we multiply these always, because we must keep on remeasuring. We multiply this by the current fair value times the time proportion. Journal entries, I've already shown you this. If it's equity settled, we shall be giving you shares, debit employee expense, then you credit equity, or what they are calling share-based payment reserve. How about cash settled? You debit employee expense, and then you credit liability. Now, ladies and gentlemen, with your permission, I will be going through 2 very simple questions today where no employee will be leaving. Yeah, and then tomorrow's 30 minutes, yeah, I'll be able to do now situations where the employees are leaving. So we start with question number 1, very easy questions today. It's about introducing this standard called Afr-Ifrs 2. So you're told Bri granted 10,000 equity settled share-based payments to each of its 20 directors on 1st January 2015. The options vest on 31st December 2017. So the options are going to vest on 31st December 2017. It is anticipated that none of the directors will live over the 3-year period. The fair value of the option is given as follows. So we have here 1st January 2015, 12 bob, fair value. So ladies and gentlemen, remember, this 1st of January 2015 is the date when these people were granted the deal. This is the grant date. Grant date. So they want us to come here and prepare the extracts to be shown in the statement of P&L and the statement of financial position for each of the 3 years, ended 31st December 2015 to 31st December 2017. So we are told here, Bri granted 10,000 equity settled share-based payments. Ladies and gentlemen, we must first of all appreciate which is really the method of paying these people, these employees. These employees, when it's equity settled, we are giving them our shares. We are not going to give them cash. No cash here. All right? Should they stay with us for those 3 years, we shall be giving them shares. We shall be giving them equity components here. So if that is the case, then this is what we call equity settled share-based payment. And the one thing that I will never forget since I was taught this, if it's equity settled, use fair value at grant date to do everything. Grant date, to do your measurements, and of course, if it is equity settled, no remeasurements will apply. No remeasurements. So what do you mean, Mwalimu? That all these changes in the fair value are irrelevant. We shall only recognize all workings here will be on the basis of this 12. The share price which existed at the date when this deal was being granted, 1st January 2015. Bri granted 10,000 equity settled share-based payments to each of its 20 directors on 1st January 2015. 1st January 2015. So then, ladies and gentlemen, I would want us now to start writing this. I hope we are okay now. We can write, because we can't just talk throughout. We must write. So I'm opening my pad here for purposes of us having a few write-ups. Great. We look for, yeah, great. All right, we get a fresh page like that. Now, ladies and gentlemen, this is what we're going to do. And I would want us to really go slow with this. So write their solution. So this solution, this is what we are doing. This solution is what we are doing. So first of all, recognize the fact that this is an equity settled share-based payment. So if that is the case, we use the grant date. We use grant date, as we said there. Grant date, fair value only. Fair value only. And this grant date, the grant date fair value is $12. We'd also use dollars at times. Use dollars at times. So, and then if this is the case, ladies and gentlemen, remember each director was being given 10,000 shares. 10,000 shares. And there are 20 of them. 20 of them. All right. And we are told in this case that the fair value as at the grant date is 12. So this is what I will do to be able to get what we call the total expense for the company. Total expense for the company. So are you able to give me this total expense for the company, ladies and gentlemen? Anybody who is able to give me this total expense for the company? Because we are told that it is 10,000. If you read the question very well, they're giving me a figure of 24. 2.4 million. 2.4 million. So this is how much the entire deal will cost us. And this will be the total expenditure for how many years have they given us, in this case here, the vesting period. Vesting period is 3 years. Vesting period is 3 years. So we have been able to get total expense, but you see, for accounting purposes, we normally talk about annual expense. So go ahead and give me annual expense. Annual expense. So remember, this is total expense for the company over the entire vesting period. So then per year it will be 2.4 million divided by 3, which will end up giving me what figure? Sylvia, thank you so much, 800,000. I mean, I love all equity settled because they are very easy to handle. Equity settled questions are very, very easy to handle. With this, you have finished everything. So simply come and give us extracts. Give us here extracted financial statements. So we have here statement of P&L, and then we have a statement of financial position. Yeah. So we have here the year ended, year end. So we have here 31st December 2015. Then we have 31st December 2016. Then we have 31st December 2017. The annual expense is what you're going to book here, 800,000 per year. 800,000 per year. Like that. Statement of financial position, you accumulate this. So year one, the expense that I'm taking in this case here, because it's not paid, it is 800,000 end of year one. So it will be, it will be an equity component at the end of the year. Then when they work for us the second year, then we recognize that their total equity will be 1.6 million. Then when they finish the third year with us, it will be this plus this. You're able to account for your total 2.4 million. 2.4 million. So, ladies and gentlemen, if there is something that I would want you to go home understanding is this. Something I would want you to go home understanding is this. Something I would want you to go home understanding is this. That ignore all pair values. All pair values. Yeah. For the year 2015, 2016, to ignore all of them, because this is equity settled. This is equity settled. Equity settled. Use only the grant date, fair value. Like that. And that is the end of that very question. All right. a simple question to demonstrate what is expected of us should we get this kind of a question. I don't know whether there is somebody who has been able to really appreciate what Mwalimu has done. Anybody who has been able to understand what Mwalimu has done? Thank you so much. Now, ladies and gentlemen, we look for another type of question, which is the last question for today. I told you these classes, we are normally stealing our employers' time. I don't want them to be too long. No. I just want them to be very, very short, but they are very impactful, very impactful. So question number 2. Gouda granted 10,000 cash settled share-based payments to each of its 20 directors on 1st January 2015. You see, this is the grant date. 1st January 2015 is the grant date. The options vest on 31st December 2017, I mean. It is anticipated that none of the directors will leave over the 3-year period. Yeah, so remember these are 3 years, 1, 2, 3 years. So vesting period is 3 years. The fair value of the options is given below. Prepare the extracts to be shown in the statement of P&L and the statement of financial position for each of the 3 years, like that. So I have to understand what IFRS 2 part am I working with here. You can see Gouda has granted 10,000 cash. So meaning that remeasurement will be on a yearly basis. The measurement will be on a yearly basis, because you see, if it's cash settled, we are very sensitive with tracking the performance of these directors on a yearly basis. So should I get this kind of a question, where do I start from? And this is where, if you look at last semester's question IFRS 2, it wasn't done very well. So is there somebody who can take a screenshot of this? Please take a screenshot of this. Take a screenshot of this, and then of course send this on your groups. Because it can be a better way at times than getting students asking for this handout all the time. Or I'll be able to send this handout. Yeah, so in 5 minutes, how will I solve this kind of a question? To solve this kind of a question, my friends, this is what I shall do. Number 1, what am I doing here? I have to start this way. The solution. This is a cash settled. This is a cash settled share-based payment. Share-based payment. Now remember here as an NB that for cash settled share-based payments, annual expense is based on fair value at each year end. So basically, this is what we are calling remeasurement on a per annum basis. Remeasurement on a per annum basis here. It's only applicable for cash-based settlements. Now, ladies and gentlemen, remember, we have to calculate here what we call our total rights. Total rights given out. So the total rights given out, remember there were 10,000 directors. 10,000 directors. No, 10,000 options given. Or 10,000 shares, 10,000 options. Yeah, 10,000 options times 20 of them, which gives me 200,000. It's very important. Now this time around, I'm not multiplying them with the grant date fair value, because that will be changing. That will be changing. That will be changing. Now, then come and make for us a simple table, a very simple table, very simple table. So this table, this is how it shall look like. This table, this is how it shall look like. This is how it shall look like. This table of ours. So we have our year end. All right. Fair value has to be mentioned because now fair value valuation is being done on a yearly basis. Give us a column for portion vested. Now, when it's cash settled, it becomes a bit tricky, but you'll be able to master this. Then give us liability at year end. And then now you come here and give us an expense. The expense, of course, this will be the profit and loss. So we start with 2015. 2015. We start with 2015. So if I share this with you, ladies and gentlemen, you'll be able to see the year ending 2015. The year ending 2015. You know, this was the starter. The year ending 2015. The fair value is 13.5. Actually, for your information, the fair value at grant date is irrelevant because you're only looking at year end. So we have here 13.5, 13.8, and 14.2. 14.2. So I hope I'll be able to remember this without making reference again. So we have 2015. Please, this one you must leave big spaces. We have 2016. We have 2017 here. Leave big spaces like that. Like that. So the fair value, age now, that is age. The fair value here is 13.5, 13.8, 14.2. Fair values 13.5. When you put black here, 13.5. This is 13.8. This is 14.2, like that. Remember, by the end of the year, these guys would have worked for us 1 year, 2 years. This will be 3. But because they want a proportional portion, so this will be 1 over the vesting period, 2 over 3, 3 over 3, because they want the proportions. And then I will come and they give us liability at the year end. Liability at the year end. It's very easy. You take 200,000 and the fair value, which is 13.5. Yeah, this is the total expense. But now remember, these ninjas have only worked for us for this asset. Are you able to give me this figure, ladies and gentlemen? So Cyprian gives me 900,000. 900,000. Wish I could also get it from someone else with this sort of figure. Yeah, Sylvia has confirmed. So we go to year number 2016. Our total shares were 200,000 times this and this times 2 over 3, which then would end up giving us what figure somewhere there? $18.40 from Cyprian. I'm waiting for somebody to second the answer. Mary Ann, $18.40. Thank you very much. So remember, you're doing remeasurement because of cash settled. So 200,000 times 14.2 times 3 over 3 times 1 basically. Times 1 basically. 2840. So this is 2840,000. Thank you so much. So remember, this liability began at the beginning of the year. By the end of the year, you can see it has been able to hit 900,000. The expense for the first year, you look at the increment from 0 to this. So expense for the first year is 900,000. Expense for the second year, we're looking at the increase from here to here, from 900,000 to 1840. And remember, to get expense of the year, expense for the year, what do? You take the closing liability minus the opening liability. 1840 minus 900,000. Joseph is giving me 940,000. 940,000. And then now this is the closing liability for the third year minus 1840,000, like that. It's giving me 1 million. Like that. So now, ladies and gentlemen, remember that now this will be this one here. This one here will be my statement of financial position extract, and this will be the P&L extract. Don't do other tables. Don't do other tables. Once you do it like that, you are good to go. You're good to go. And that is the end of my today's session, ladies and gentlemen. I'm looking forward to meeting you again tomorrow at the same time for us to be able to handle the question that was tested last semester and other questions here. So thank you so much. So don't miss tomorrow's class. And of course, the RCM students, they don't pay anything extra for this revision. But students from outside there, we are welcoming them to join RCM. Our number is 0793 555 000. 0793 555 000. I'll share this on your WhatsApp. I'll share the handout on your WhatsApp. Bye. All right.